Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis. Today's Thursday, August 7th, 2014. And another down day in the SPY. This is the daily chart. I just want to roll back the clock one day and take a look at the 60-minute chart because if you remember, actually, let's start with the 10-minute chart. If you remember from yesterday, where's yesterday? So yesterday is 10-minute chart. Whoops, I'm all the way back here. Okay. So yesterday we start down, we rally up, and then we kind of go sideways the rest of the day. And then I said that this was a bearish pattern, right? But then I said, but look at the 60-minute chart, which overrides the 10-minute chart. Okay, and here we go. This is yesterday, and then we go sideways, and this is a bullish pattern. And I told you this was a bullish pattern, and I said that this could pop. But what happened today was it popped at the open, and then we melted down sideways most of the afternoon, and then it started down towards the end. And basically, this market's still in sell mode. You're below all the moving averages on the 60-minute chart. Let's go over to the daily chart, and I'll show you where we stand. Nothing's really changed. You've got the 20 converging into the 50 moving average up here. You're above the 200-period moving average. You almost hit this gap fill today over here, okay, and this would be at 190.48, okay, and you almost hit that here today. All right, and then you have this pivot high here, and I had said yesterday, and I still hold this true, that I think you're going to get some kind of a bounce at about 189 to 190. It just feels like the market should bounce. However, remember the rubber band analogy from yesterday also. You can stretch a rubber band, and normally it snaps back. But if you keep stretching it, right, and you don't bounce and you don't snap it back, it's going to break. So that's the other scenario. If this market breaks, okay, you'll probably slice through the 200 and you're going to probably go down to this double bottom here. Not necessarily in one day, but that's when some really heavy selling pressure is going to come about. So you got to just keep in mind, you got a lot of stuff going on around the world. You got Russia, the Ukraine. Russia is lining up troops, firing missiles. You know, who knows what they're doing over there. So that's a problem, right? We've issued sanctions, and obviously they're not happy with that, but they're thumbing their nose at us. They don't really care what we think. They're going to do what they want, right? Putin's going to do what he wants. He already took Crimea, so he's going to do something else next, and that's inevitable. Then you have what's going on in Israel and the Palestinians and Gaza and all that stuff. That's not over. That's a ceasefire. That won't be a ceasefire in a couple of days, and they'll be back firing at each other. And then you have Iraq, and apparently today we announced that we're going to start some kind of military exercise in Iraq to stop this madness that's going on over there with this ISIS group. I mean, everything's gone mad around the world. Don't forget about the wild card, which is North Korea. They'll fire a missile at some point and, do the saber rattling that they do. And then you have Iran hanging around building nuclear bombs and promising they're not when they are. So all that stuff, I don't want to get into a whole geopolitical discussion. I'm just saying that something's going to happen that's going to jolt the markets one way or the other, and more likely on the downside than the upside, right? You'll get some bounces, and even if you get a bounce from here, where are you going to go? Okay, well, you'll go as high as these moving averages, in my opinion, in this gap window here, but I don't even think you get up there. Maybe 194, that's about my target right now. If we were to bounce, let's say tomorrow or Monday, 194, and then you look to short into that bounce, okay? By the way, speaking of short into the bounce, we had another trade that we took half off the table today for the members, which was SMH, which is the semiconductor index. We were short the semis. All right, let me get that up on the screen. We were short the semis, and up here, okay, and we took it off the table, half of it today. We lock in the profit by putting a break-even stop, and then we let the rest ride. So it's a guaranteed winner no matter what happens, and nice trade. I didn't add up the percentages, but it has to be more than 5% in less than 2 weeks. So the rest of it could be 10, 20%. Who knows? We'll see what happens when we get there. But nevertheless, we'll trail our stop on the way down and we'll keep adjusting it lower, lower, lower. That's a buy stop when you short a stock. And then, we'll lock in as much profit as we can. So here's another one. Yesterday we did FedEx. Today we do SMH. And that's it. That's just in case the market does bounce, has a short covering rally. We want to be able to lock in some profits. And you know what? Maybe we put on the other half back on at higher prices later, and that's fine too. So we got some other tricks out there as well, but I'm not going to talk about them here. I'll save it for the members. There's some other short plays, and then there's a long play that was issued today. So we've got both sides of the market covered. Again, I'm not a bull or a bear. I don't care which way it goes. All I care is that I can read the tape. That's it. As long as we can read the tape, we can put on profitable trades. All right, let's jump over to the gold market because gold had a little bit of an update today. Most of the day it was down to flat. In fact, let's take a look at the 10-minute chart. So we're down, then we rally back up with the market. As the market's selling off, gold's rallying. So it looks like, right? I mean, if we go and just take another look at the daily chart, you can start to see here's a bullish pattern. It's starting to break it. It's kind of choppy. It's not great, but it's starting to rally a little bit, and it's held up when the market's coming down. Okay, gold is actually getting stronger. So that's telling me that at some point in time, it's going to be called the fear trade, and gold's going to rally substantially as the market's coming down. That's what that's telling me. So that's the way we're playing it. We're just not ready yet. You know what I said last night? Time and price, when they converge, that's when the trades will be put on. So we're getting close, but we're not there yet. Oil. USO, I'll take a look at USO, and it's still sick. And I just don't, it's forming another bearish pattern. I don't like it. I'm going to take a look at I want to look at the weekly chart with you. On a weekly basis, I'm still saying that we're going to get down, and I think we're going to get to this level here. This low is 34.97, maybe even lower. We'll have to see how it gets down there. But when we get there, I'll see what the pattern looks like, and if it's ripe for a trade alert, I'll issue one to the members. But it's weak. There's something wrong with oil. It should be rallying in the face of what's going on, and it's not. What that tells you is that oil, in the minds of the traders, is more tied to the economy. And if the market's coming down, they'll talk about the economy remaining or getting weaker. And then if the economy's getting weaker, less demand for oil, less manufacturing, less production. And could be the reason why you're starting to see weakness in the price of oil. So that's kind of my take on the story. If you have to put a story behind oil, that's the story. You know what? We haven't looked at interest rates in a while. So let's take a look at the 10-year. And the 10-year, that's the weekly. I want to go over to the daily. And let's take a look at the 10-year. And guess what? The 10-year melted all the way back down, and you're coming into this double bottom low, which is at 240. So I don't think you're going to get much lower than 240. I would be shocked. I would be surprised. But if that being the case, you probably look for a bounce. And you know what? If you think about it, right, just logic, right? This is the common sense stuff. Logic says that if interest rates were coming down as the market's coming down, right, bond prices are going up as the market's coming down. Why? Because money is coming from the stock market to the bond market, pushing the price of bonds higher and the yields lower. And that's what's happening here. So if we come into double bottom, let's say tomorrow or Monday, and we reverse, couldn't you see a reversal coinciding with a reversal in the stock market? Lower bond prices, higher interest rates, higher stock prices, right? Just makes sense. If this is going, I'm not saying it has to be correlated. I'm just saying if it is now, if this is a correlation to the market, and if this correlation is coming to an end here, okay, or not an end, but it's coming to a short-term bottom or maybe even a longer-term bottom, remains to be seen. If that's the case and we're going to have a turn, and if we're going to have a turn in the correlated market, that just maybe it says that the market's ready to bounce. We'll see. These are the things I'm looking at. I'm looking at any correlations that exist. I'm looking at indicators. One of the indicators, this is the last thing I'm going to discuss tonight. One of the indicators I look at is the VIX. And what was interesting today was the VIX was kind of hanging around. Even when the market was down, it really wasn't up that much. And it went up a little bit. Let's take a look at an intraday chart of the VIX, right? 10-minute chart. Okay, so here goes the VIX, all right? And it did go up when the market was at its low point of the day, in the afternoon at least, right? But then it sold off, but it really wasn't a spike up like it did the other day. It was just kind of hanging around. It just went from here to here. It wasn't one of these wild ones. I don't know if I'm making too much out of the VIX. I just didn't think that there was any panic out there. I didn't think that the VIX was in spike mode today like it normally is when the market sells off. And the market wasn't down that much, but it was still 1%, a little over 1%. So if the market's down 1%, I would think that's decent enough to get a better spike in the VIX. That's just my take on the VIX. I'm not saying I'm reading anything into it. I'm just saying I observed the lack of higher prices and panic in the VIX that we saw in prior sell-offs on this go-around. That's all I'm saying. Anyway, I'm going to leave it there tonight, folks. I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.